Hi traders, and welcome to the last part on my series on order flow, reading it and using it to trade profitably. So today I want to talk about three things: fleeting orders, layering, and large volume, and how that impacts the market. So first of all, what is a fleeting order? There are many bots that regulate this market with the limit orders. And sometimes you'll see numbers fluctuate from one number to another, and that's just simply a bot or a collection of bots inputting orders based on the actions of other bots or humans. So some fleeting orders are just part of the market, and some can also be malicious or have intent to influence the market. So what I mean by that is that if a bot or someone was to make a fleeting order where, let's say this was jumping from 16.3 to like 80, and it kept on jumping, except the 80 was not changing, it was just a flat 80. What that might mean is that the bots are trying to influence the actions of others with a fleeting order. And what that might do is cause many traders to sell. Next up is layering. So layering is similar to fleeting orders, except it's where a bot or a human or an institution puts a large amount of orders on one price level, and whenever that price gets approached, it never activates. So I'll give you an example. Let's say there were 100 Bitcoin being sold at 25.56, and when price got up there, they all vanished, but none were sold. What that likely means is layering, where there were market participants who wanted to push price down because they layered the offers, and in doing so, they did not want to sell their contracts. They just wanted to push price down. So that might seem a little complicated with layering and fleeting orders, but it should remind you that not everything in the order book is face value, and that some traders will manipulate the order book in order to manipulate others so that they can manipulate the price. The last thing I want to talk about is the impact of large amounts of volume hitting the market. So when there's a large market order, usually price will shoot up and create a large tail, or shoot down and create a large tail, as we can see here. This is a prime example of a dump of Bitcoin and another dump of Bitcoin. And this can mean a lot of things. In a lot of instances that I've noticed, usually we can see that when a lot is being sold all at once, that price tends to go in the other direction. That's not as much in the case here, but I've noticed that to be true a lot of the time. That, for example, if one trader sells off a lot of Bitcoin, usually price tends to recover, as you can see here in a bit of this structure. And then let's say if a lot of buying occurred, you can see the price tends to go down. So this might seem a little confusing, but just think about it like this. When one large market participant wants to buy or sell a large amount of Bitcoin, usually what's going to happen is that their action is going to go against the market. So a lot of buying will create a bit of a sell-off. A lot of selling will create a bit of a buy-off, as liquidity is provided for the other side. Now, like I've said before, in order for price to go up, there needs to be market participants who are willing to buy at a higher price, and for the price to go down, there needs to be market participants who are willing to sell at a lower price. So what's more important is not the action of one large trader, but rather the actions of many traders in conjunction with each other in deciding the price. Thank you, and leave any questions that you might not understand in the comments.